Welcome, options traders. Hello, everyone. I thought today would be a really good day to post a video on the differences between the Dow and the S&P 500 and why they can have, at times, such dramatic performance differences. And thought it would be a good day after the historic run we had yesterday on November 7th of 2018, the biggest spike in the Dow since 1982, also coming off the back of the midterms. But sometimes you will see that the Dow might be up and the S&P is down. Or they might both be up, but the Dow is up a whole lot more. And the new traders often say, well, how can that be if both of these indexes are to monitor the performance of the market? And which one should I use? So let's take a look at the Dow and the S&P 500 and why they can have such dramatic performance differences. Within the financial markets, we got lots of indexes out there. You've got the Russell, and there's a family within that. There's a 1,000, a 2,000, a 3,000. There's even a 2,500. There's a Wilshire 5,000. There's a Wilshire 4,500. There's tons of indexes out there, but they can all be boiled down into two basic types. You have what are called price-weighted indexes, and you have what are called capitalization-weighted. And that's really going to be the key to understand the differences between the Dow and the S&P 500. So let's start off with the Dow Jones Industrial Average. It is the second oldest index in use. A lot of people think it is the oldest. It is not. It is the Dow Jones Transports, or the transportation averages, that was the oldest. And this index was first published in 1896 in what was called, if you can believe this, the Customer's Afternoon Letter. That was the original name of the Wall Street Journal. But even though it is the second oldest index in use, it is probably the most widely quoted index. Everybody quotes the Dow. Everybody knows the level of the Dow. Few people know where the S&P is, but everybody knows the Dow. But the thing that can throw the calculations and your perceptions and what's going on in the market is the fact that the Dow is a price-weighted index. And as I'll show in a little bit, that means it is easily influenced by a single stock. Now, just for a little bit of history, the Dow originally had 12 members. That's what they call them. The stocks that are in that grouping there only had 12 stocks. And you can see that none of them are probably names that you recognize other than General Electric, GE, but it just got booted in June of this year of 2018. So GE for a long time was the only surviving member of the Dow, but not anymore. Not a single original member in there. Today, as most of you know, the Dow has 30 different stocks or members in there, and I've got them listed and according to the year that they entered the index. And you can see big changes right around 2000. And that's because, obviously, with the technology and with the internet, lots of changes in the economy, and the Dow tries to select a handful of stocks that best represent the overall economy. So we saw very big changes going on. And down here is Walgreens, 2018, most recent member. That's the one that replaced GE. But still very small nonetheless, only 30 companies in the index. Now, the S&P 500, on the other hand, more commonly known as the SPX, that's the ticker that you would stick in most platforms to get a quote on it, was developed by Standard & Poor's, founded in 1860. So both of these are very old indexes. And it was originally developed by a man named Henry Varnum Poor, and in 1941 merged with Standard Statistics. And that's how it became Standard & Poor's. And in 1923, it had a very small number of stocks. In 1926, it had about 90 stocks. And then finally in 57 expanded to 500 stocks. Now the reason I said roughly 500 at the beginning is that there are actually 5 stocks in the index that have 2 different classes, so like an A share and a B share. There's actually technically 505 tickers, even though it's called the S&P 500. Now this index is the most widely used measure of stock price levels. So if you were trying to say what happened in the market, or what has gone on in the last 5 years, this is really the index that you want to look at. Money managers all compared to the S&P 500. Nobody's performance is compared to the Dow. It is always to the S&P 500. And it's important to understand because a lot of new traders all try to base performances on the Dow. But the biggest difference between the S&P 500 and the Dow is not just the number of stocks. It's that the S&P 500 is a capitalization-weighted index. So let's find out what these mean and why they make such a difference. All right, to start out explaining things, let's start off with a very small index. Let's say this is back when the Dow was first created. And we're only going to put 5 stocks in it, A, B, C, D, and E. And the closing prices were 30 through 70 like this. Well, if we added up these 5 stocks and we divided by 5, we would get 50. But now let's say that one of these stocks does a 2-for-1 split. So instead of this one here trading at 50, it's now trading at 25. Now watch what happens to our number down here. It drops to 45. Well, that hardly seems fair. It looks like the index took a big hit when it was nothing but a stock split. And we all know that stock splits really don't change anything about the company's value. But if we didn't make any changes here, it would look like our index took a really big dip. So how does the Dow correct for it? Well, all we would have to do is take the current level right now, divide it by the old level, 45 divided by 50. We get 0.9. So if I took this number here, my new calculation, if I say let's take this number divided by 0.9, we'll call that kind of a correction factor, I get 50. So this index would still be reported as 50, as it should. Nothing really happened structurally to these companies that says it was trading at 45. It was just a stock split. So what this means is that now all future calculations have to be divided by 0.9. So no matter what happens to these prices on the next day, we're going to add them up, but instead of dividing by 5, we're going to divide by 0.9. And that's just a little kind of a mathematical trick that we have to do to keep the index balanced. All right, so if that makes sense, let's take a look at an actual spreadsheet. Now I've got what are called some RTD links in here that are linked out to actual quotes. So if you watch, these prices will change. Markets are now open. It's a little after 2 o'clock on Thursday, and you'll see these prices change. It's showing us the last trade. There they go, the net difference, and the effect on the Dow, which I'll explain in just a moment. So here are the 30 stocks in the Dow, and these are the current prices. And if we were to add those up, we get 3861 and change right here. But, and you can look this up on the web, we need to know the Dow's divisor. After all of these years of changes and mergers and acquisitions and stock splits and members getting put in and kicked out, the divisor has changed. Mostly it's gone down, but there are some years that it goes up. And so right now the divisor is this 0.1474 number right here. So if we take this 3862 number and divide by the Dow's divisor, we get 26,190. And so if we go up here to the actual Dow, we get 26,205. Now the reason for the slight discrepancy is because there's a delay between when the DJX or the Dow Jones Industrials is being updated versus my calculations. But this is exactly how that number is being calculated. Now we can also look at something else interesting. I can take 1 divided by this 0.147 number and I get 6.78. And what that means is that every single dollar change in one of these companies makes about a $6.8 change in the Dow, or a point change in the Dow. So if you look at the effect, well, I've got this column called the Dow effect, you can see that 3M is up $2.35 today. It's accounting for 16 points of the 25 points in the Dow. Down here, United Health, trading up $1.68. That's giving the Dow a boost of 11 points. McDonald's right here up $1.59, also adding about 10 points. Now, obviously, there are some like IBM that's subtracting 10. But the point is that just a handful of stocks can actually be driving almost the entire value of the Dow. So yeah, it has 30 stocks in it, but on some days, if one of these stocks is having an exceptionally good day, the index is really just tracking that one stock. Now, another interesting thing about the Dow is that the stock with the highest price is going to have the biggest influence. So if you look here, 3M trading for about $203, that's part of the reason it's having such a big effect. $200 stock is going to have a much better chance of moving a dollar or two than one that's trading for 20 or 30 bucks. But let's come down here. You'll see Goldman Sachs trading for almost $232. That used to have the most influence until recently when United Health trading up over $276. So again, higher price stocks have a better chance of moving a dollar than, let's say, a $10 stock like GE. And that's why these very expensive stocks in the Dow will carry the most influence. So again, even though it's 30 stocks, on any given day, it could just be 1 or 2, 3 stocks in there that we're really tracking. We're not really looking at anything close to the overall market. However, let's go see how the S&P is calculated. I'm not going to go through obviously all 500 stocks in there, or 505, but let's just take a look at the top 6 right here. And again, these are live quotes. But we're also going to look at the number of shares outstanding. And so if we take the last trade times the shares outstanding, we get what's called the market capitalization. And so that's theoretically what the full value of this firm is. That's what you'd have to pay to acquire this company, at least theoretically. So very, very expensive companies. So if we were to add up the market caps for all of these 500 or 505 tickers in there, we're going to get this whopping $19 trillion market cap. So what we will do is we're going to take a look at 3M, and we're going to divide its market cap by the total market cap of the entire index, and we see that it's only about 0.62%. Very small influence on the entire index. But watch what happens if we split a stock. Let's say that 3M up here does a 2-for-1 split. Let's just call it 200, and it goes down to 100. What's going to happen? Well, the price gets knocked in half from 200 to 100, but the number of shares outstanding doubles. So mathematically, it has absolutely no effect on the market cap. We don't need to do this little mathematical trick with a divisor. It all happens automatically. But the main thing about the S&P 500 is that it is the size of the company that has the most influence, not the one that has the largest price. So keep those points in mind whenever you're looking at, especially on some market days when you might see the Dow is way up and the S&P is flat, and you're just sitting there scratching your head wondering why. Now you understand. One is a price-weighted index and one is a market cap-weighted index. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.